It's over. Did you participate in the recent equity fundraising? I took part in it and I also received my access application. The original idea of this video was the acquisition. However, after attending the extraordinary general meeting held last Friday, I learned a little bit more of our Keppel DC REIT business. So continue to watch. Information shown here is taken from the acquisition presentation. On this slide, yes, it is AI ready hyperscale data centers within a campus in Singapore. It's kind of a mouthful, but out of all the information in this slide, the outstanding one that I wanted to know is the tenants. So we can see that it's 100% contracted to hyperscalers, and these two data centers have 3 and 4 clients, and that addresses the tenant concentration risk because earlier we had the infamous Guangdong DC incident. Okay? If you need a refresher, you can find the video link found in the description below. Subsequently, if we look at this acquisition overview slide, what do I observe? The left side, it is the valuation done by all the independent assessors. But on the right side, the thing that I focus on is actually the contract type because it is co-location. And you might be thinking right now, why does it even matter to me? Because of two things. One, it gives me an idea of the business strategy that my Keppel DC REIT managers wants to execute. Okay. Second is the expected gross profit margins of these two data centers, which is around 87%. Even though it's based on 30th June 2024, but you can see that our REIT managers gave us the numbers based on the type of asset classes. You can see there's co-location, fully fitted, shell and core. So I wanted to make sure that, okay, these two new data centers coming in the portfolio is actually going to maintain existing performance. And you might be thinking right now, why do I even need to know this? Because simply a higher gross profit margin would mean a higher profit possibility for our data center business. So that also increases the capability of the business to pay a higher dividend. And something to take note, when we acquire these two data centers for the KDC Singapore A, there's income support during the fit out period because it's going to be fully occupied by third quarter 2025. So from now till then, the sellers will actually be providing income support. The next part that you might also want to take note, because this is new information to me, KDC S3 is going to be a master tenant of these two new DCs for the next 10 years. And in fact, this is the fixed rent per annum table that KDC S3 will pay to Keppel DC REIT. And on top of that, there's also going to be a variable rent that Keppel DC REIT will be receiving. So you can see in this table, for the two DCs, the fixed rent for the first year all the way until the 10th year. You might be wondering, why is this important? Because if I as an investor have visibility over the earnings, wouldn't you pay a premium? However, something to take note, not all is glory. If the EBITDA for the master tenant is negative, KDC REIT will have to refund all the rent received from the master tenant. So that's something to take note. Of course, now we move on to the investment merits. All is agreeable. However, there's one thing I want to go through, which is this strategy addition. What's my take on it? First, I interpret the merit of strengthening the foothold in Singapore in 3 ways. First, we transfer the co-location market share to Keppel DC REIT. And of course, the low co-location vacancies bringing the side effects of growth in co-location rates. And the third one is, are we increasing our Singapore asset exposure from 53.1 to 65.5 a double-edged sword. Are you comfortable with this kind of exposure? Ang Ting Lai 1097, he recently gave his input on my YouTube video. And it goes like this: few mega DCs are going to come up in JB, plus there's going to be a completion of the RTS. What is my view? Will the clients relocate to JB? By then, Keppel DC REIT will have less bargaining power for higher rent reversions. My inputs: 1. Yes, DCs in JB can offer an alternative to Keppel DC. That's definitely certain. And it is possible that clients can relocate to JB. However, the next question that I have in mind is two things. 1. Ease of tenant relocation, plus the service standards towards the customers of the tenants. Because third point, if I'm end user of data center services, I would want to locate wherever I can so that my business enjoys low latency. I started my circle of competence in data centers right from the business operational results, such as their gross profit margins, gross margins across different locations like US, Europe, and Asia, returns on their borrowing. So you might want to watch this video, okay, on data centers found in different locations. It compares Keppel DC with Digital Core and also Mapletree Industrial Trust, and it will surprise you. Of course, the next investment merit is these multiple levers to drive further growth via rental uplifts and capacity expansion. I definitely love it, though I prefer the organic factor of potential capacity expansion before the inorganic factor of potential rent reversions. But all these business actions lead us to this outcome that matters the most. It's actually the DPU accretion. We are looking towards getting the extension of the land lease. So being conservative, what's my valuation? So let's just take the dividend that's written on the right side. Okay, that's 4.867 cents based on the first half. So if you just analyze it, means you multiply by 2, we'll get a 9.734 cents. Since we invested $2.03 as the purchase price, that's a 4.79% dividend yield. Does that yield fit what you need? But more importantly, is that all the potential business growth? As of recording, I am a shareholder, so practice independent thinking as I am biased. I feel there is potential business growth. It's just only piecing up the information. Because what's more is the renewal of 2 master lease agreements with KDC S1 and KDC S2. These renewals involve at least 30% fixed rent reversions, as you can see from these 2 tables. So I'm going to just sit here for 2 seconds each. So for SGP1 master lease agreement, you can see that the new lease agreement is actually higher than the existing KDC SGP1 master lease agreement that has expired. This gives me earnings visibility on the fixed rent for KDC Singapore 1 and also KDC Singapore 2. So if we just do the figures, taking the earlier rent of the first year and compare it to the new master lease agreement, each year is almost an increment of 30%. But you might be thinking right now, is it significant or not, right? Is it significant? This is one of the important questions that I also asked myself when I saw this table. Every time our REIT managers release the results, there is this table at the end, right? You can see the attributable gross revenue from each data center. If I compare for KDC S1 for the new rental agreement, it is 6.7 million versus a base of 17 million. That's around 30%. And even for KDC S2, if you compare the fixed rent over the rent that they got financial year 2023, that's around 40%. Is it significant enough? You make the comparison. But how about the other three data centers in Singapore, which is KDC S3, KDC S4, and KDC S5? These three data centers are not due for renewal regarding their master lease agreement, but in the circular, okay, this circular, you can find this table. It provides some visibility to revenue forecast, and you can see that KDC S3, the fixed rent for KDC S4, likewise for KDC S5. And moreover, take note, in my earlier video, I also note that KDC has also announced a few other activities earlier in 2024, such as 1. The Tokyo data center acquisition. Second is the Gore Hill data center in Australia. So what's your take after hearing this bunch of information? Recently, because I'm recording this on the 22nd December, it seems to be a price correction for REITs. You decide. Early on, I recommend you to watch this video on data centers in different locations. The results surprised me. So watch it before you buy Mapletree Industrial Trust. It might change your idea of venturing into the US data center market.